Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. Got another video episode for you. So as always, head over to the Spotify or the YouTube if you want to check out the visual experience. So the other day I shared an image on the YouTube community tab. I'm trying to do that more often because, I don't really use like Facebook or Twitter anymore. So it's a cool place to share and you guys seem to enjoy it. And it was an image of like a handwritten letter that said, do not add to losses, do not add to losses, do not add to losses, about like 20 times down. And a lot of traders got a good laugh out of it, including myself. But then it got a little bit serious. I did receive a few kind of public and private messages from people saying, hey Akil, unfortunately this is where I'm at in my trading, where I do such a good job for a short period of time, but then this is the mistake that I make and it brings me all the way back to square one. So because this is a podcast for you, by you, meaning I take what you guys bring to me and I put it into stuff and give it back to you. Yeah, that sounds about right. That is the subject that I wanted to discuss today. And it gives me a very cool excuse to also talk about two of my favorite subjects in trading, which is game theory and the sunk cost fallacy. So let's start off with game theory, right? Game theory is essentially this. It is the study of decision making under uncertain circumstances. So conditions where you're uncertain of the outcome. It was originally developed to better understand economic behavior. So like why people are buying at certain prices, why people are selling at certain prices, why people decide to work for certain wages but not other wages. Pretty much the whole supply and demand thing that we talk about all the time in trading. With that being said, it's also used in many other areas as well. It's used in biology. It's used in like international relationships, kind of regular relationships. So like boyfriend, girlfriend, friendships, parenting, families, and yes, trading as well. As I suppose trading would classify as a place where we have to consistently make decisions under uncertain conditions, meaning we don't know what the market's going to do ever. Now, one of the biggest things that game theory also taught us, and this is really relevant to trading, and this may be a myth buster for you, is this. So when we go into trading, we tend to think it's something that is called a zero-sum situation, right? A zero-sum game. And what a zero-sum game is essentially where it's like you have two parties that are competing and they're against each other, meaning that if this is person A and this is person B, if person A wins, person B loses. If person B wins, person A loses. It's either one or the other. But the truth is, with trading and in many circumstances with game theory as well, these aren't always direct competitions. These aren't always zero-sum games. Unlike Squid Game, where someone must be eliminated, in real life, many of these conditions can actually allow for cooperations where both parties can win, and there's not necessarily an enemy in the situation. And this is huge for traders because, again, many traders believe that trading is a zero-sum game, right? Traders they're pretty much two parties in trading, right? There are buyers and there are sellers. And it's assumed that in order for a buyer to win, a seller must lose. In order for a seller to win, a buyer must lose. And it kind of makes sense if you think about it on kind of a base level. But the reality is this is not true at all. Now, not to get into a whole thing about buying and selling, because you guys know I can go on forever about like the psychology of price action, but to try to make this very simple, both a buyer and seller can profit on the same type of move. So for an example, if I'm a buyer and I'm buying at $100 and I am a seller and I'm looking to sell at $150, if price goes up from 1 to 150, that original buyer is looking to take profit. In order to take profit, they are going to sell. Their sell orders are going to be at the exact same point that the seller is looking to enter a trade, and boom, it goes down. So you can see that you have a situation where two traders are doing two independent things, and it's not necessarily one versus the other. In a weird way, without even knowing it, they are working in some sort of harmony, right? The buyer taking profit, winning, is allowing the seller to get involved in the trade and have a better chance at winning in their own right. So both can work together. And this is something, if you ever spend time with me on the charts, we call it think like the other trader, where when we're setting up our trading opportunities as far as like both stops, but mainly entries and targets, If I'm a buyer, I'm trying to think like a seller. Where would the sellers be interested in? Where would the sellers want to be in? Where would the sellers want to be out? Because that's going to give me more clues at what I should do as a buyer, and of course, vice versa as a seller. Now, it's all cool from the charting and technical perspective, but mentally, it makes a massive difference as well. Why? Well, because knowing this information, knowing that it's not a direct head-to-head fight between buyers and sellers and one has to win and one has to lose, but in fact, both can win, both can also lose as well. What it does is it allows you to block out that outside noise, right? And what I'm talking about is when like traders disagree with you. I remember as a very young trader, it was one of my first times being public. I wasn't supposed to be on a chat forum, but I was on a chat forum because I didn't really have any support system. I didn't have a tier 1 trading full of established traders willing to help the newbies like myself adjust and adapt to the markets. I didn't have super cool coaches like that Akil Stokes guy and that Jason Greystone dude. I was on my own, swimming out there in the wild waters of trading, and I stumbled across a forum. And I remember sitting back and I would just watch the forum. I was always too scared to type stuff in, and I'm taking advantage, blah, blah, blah. And eventually one day I said, hey, Akil, I'm going to involve myself some. I'm going to type something into the forum. And I remember I shot over an idea on the euro dollar. I can't remember if it was bullish or bearish, but let's just say it was bearish. I said, hey guys, newbie here, looking for shorts on the euro dollar. Here's my chart, all this fun stuff. And I'm all excited. People are going to give me feedback. What am I going to learn from this situation? And then all of a sudden, right, Scottie Pippen comes dribbling down the forum's court and says, yeah, we should all get long euro dollar. That's a dumb idea. And heart broken, destroyed, right? Confidence all gone. So, of course, in typical newbie fashion, what do you think I did? I never took the trade because Scottie Pippen, he's got all these likes and whatever the rating scale was because he puts the most stuff into the chat. He said it was a bad idea. This guy must be an expert because he's got a lot of followers. Therefore, I'm not going to involve myself in a trade and I'm going to keep my powder dry and not lose any money. What do you think happened? Yeah. My original entry won and it won big. Can you guess who wasn't involved? Yeah. This guy right here, all because I let an outside source influence my decision. And this wasn't the only time that happened to me. This happens to you guys a lot, I'm sure, where, you have an independent idea and then maybe someone you look up to comes in, maybe Jason Greystone or maybe myself comes in and says, hey guys, I'm looking at this idea, and you're like, oh crap, man, I was looking the other way, right? Not even worried about what type of system or strategy we're trading. You just saw that your coach, your mentor is looking for a different idea than you are, and all of a sudden you're discouraged. So when you have this understanding that, yes, I could be looking to trade this way, but it is independent, it has nothing to do with your analysis, it gives you more confidence to actually take the trades that you should be taking. 2, it just gives you more confidence in decision making in general, right? No longer do you see like the market as an opponent that is trying to beat you. You just are operating independently. And this is big. It is the difference between like doing a task on your own versus doing your task in like a competition setting. So I'm kind of having a brain fart for analogy ideas, but like, let's say my task was to make 10 foul shots in a row, right? It doesn't, if I'm by myself shooting 10 foul shots, right, it's pretty easy, right? But all of a sudden, if you put someone right next to me and we're shooting at the same time, even if my result has nothing to do with their result, there's a little bit more pressure. I'm rushing my shots. I want to get off before them. I'm trying to beat them to 10, right? I'm starting to make mistakes all because I feel it's a competition, even if it really isn't a competition. And as traders, that often happens to us where we feel like we are in this competition against this type of trader or that type of trader or even the market in itself. And it just adds a pressure that we don't need because, let's be honest, trading carries a lot of pressure by itself, right? The last thing we need to do is make our situation even harder. Now, going back to the general premise of game theory and making decisions under conditions of uncertainty, poker is an excellent example of this. You see, in poker, obviously you are playing against other people at the table or other people at your online table, whatever it may be, and the goal is to make money. And just like trading, there is a massive uncertainty that comes with poker, right? One, you have no control over the cards that you are dealt. You can't control whether you get a good hand or a bad hand. Two, you have no control over the cards that your opponents are dealt. You have no control if they are given a super hand or a poor hand. Again, very similar to trading, where we operate under conditions where the market will do whatever it wants whenever it wants to do it. I put out the podcast episode, I think it was 1255, where we talked about the Bank of England interest rate decision and how they cut rates, which theoretically should mean weak for currency, but the pound shot up, which was good for currency, and people were trying to figure out why the hell it happened. And we kind of broke down what actually caused it, but the point was, we could do all the analysis in the world. We had no idea how the market was going to react to that situation until it reacted to that situation. We just don't know. Now, because of this uncertainty in poker, we'll stick with this example for now. Successful poker players and successful traders as well, I guess, they need to do two things. They need to have a plan that maximizes their gains when they are right. They need to have a plan that minimizes their losses when they are wrong. And that's how you exist for the long term. Now, I'm not the greatest fan of this saying because you can take it too far. You can abuse it, I suppose. But there's a good old-fashioned saying in trading that says, let your winners run and cut your losses short. Now, just to touch on it before you take it to the extreme, I would add, let your winners run within reason to the potential profit area that you projected it to run to, and cut your losses short, but not too short, short being based on the original stop loss area that you chose before you ever took the trade. You can see how my version is a little bit wordy and not as catchy as the other version, but what I'm trying to say is you don't want to just be like every winner, no target, let it ride, right? Because eventually it will come up and go back down and you'll get nothing. And you don't want to cut your losses after it goes like 1 pip against you, because now you don't give yourself enough breathing room and you can easily be stopped out, and then the market goes on and rides without you. So maybe you do want to use my long version if you want, or just keep that in mind when reciting the short one. Either way, this leads into our next topic, which is going to be the sunk cost fallacy. The sunk cost fallacy is a situation where a person refuses to abandon a course of action because they've already invested heavily into it, even when walking away would be the clear and obvious better decision. Back to poker. So this is the moment in poker where you got your cards, you kind of figure out, I'm not a poker player, but you kind of figure out if you have a good hand or a bad hand, and then you push some chips into the table and you raise it, I think is what it's called, right? And then at some point, it becomes blatantly obvious, or maybe painfully obvious, that you do not have the best hand at the table, that he has a better hand, she has a better hand, and they have a better hand over there. And the common sense reaction would be to fold and be like, oh, I'm out. I'm not going to win. Can't do it. You obviously are going to beat me, so why invest any money? I'll just lose what's out there and live to fight another hand. But instead of making the rational decision, we, for some reason, decide to push more chips into the table or onto the table, even though we have a very low, if not impossible, chance of winning. Makes no sense, right? We call this, and I promise this is a scientific term, the screw it, I've already come this far, YOLO, right? You only live once type of thing, which is another thing that never made sense. Yes, you only live once, so yeah, whatever, I'm not going to go into that. But that was another one that I didn't really get. People were screaming YOLO and like jumping off of cliffs. And I'm like, yes, you only live once, and now you use that up and you have no more lives left. So yeah. Anyway, back to trading now. So in trading, we see this in a few common ways, right? The first and most common way, I would say, and let me know if you've ever experienced this, right? Type it in the comment section below. And if you don't, you're just going to be one lonely trader out there that thinks they're a loser and they're the only one making this mistake. So please don't let that trader be by themselves. But we see this in when traders move their stop loss. Dun, dun, dun. The cardinal sin, right? So imagine this, right? You set your trade up, entry, stops, and targets, right? Your entry is where your entry is, your target's where your targets are, your stops are at a place where you know you're wrong. price comes down, it barrows through all of your like protective levels. So for me, that's structure, right? I always have my stop loss under a key level of structure. That key level of structure is like the protection area, where it's like, this is the last line of defense. If it breaks it, my king and queen are screwed. So price action goes through, it barrels through that level of structure, and therefore I believe I'm screwed. But instead of just accepting defeat and bowing and kissing the ring of the new king, I decide to push that stop loss a little bit back. And as price gets lower, I push it a little bit back. And as price gets lower, I push it a little bit back, right? Now, why am I doing this? Well, I got a simple reason for you. Whoa! I've been sniffing the hopium. What is the hopium? It is not a drug, although it does sound like opium, which is a drug. But the hopium is a trading drug that you take where you don't want to admit defeat, and you just keep moving your stop loss back, hoping that price will reverse before it hits it. Here's the secret though, come closer, right? It never does. It always gets you. It always gets you. And then what happens is you just end up losing more money than you would have lost in the first place, right? Makes no sense, but you know what? Screw it. YOLO! Now, the second situation is very similar to the first one, but instead of just moving your stop loss back, as price is trudging through your protective area and inching ever so close to your stop loss, you decide that the best idea would be to add to your position. I'm not even going to get into why this is a very, very bad idea, especially if it's not predetermined. But yeah, traders do it, and then once again, they end up losing more money than they originally planned. Now, continuing on this sunk cost trap, I want to peel the onion, right? That makes you cry. I don't know why we would do that, but I've heard it before. Let's peel the onion back on this and kind of understand why, because in my almost 2 decades of coaching athletes, I understand that when you just tell someone what they're doing wrong, it's cool, it brings it to their attention, but it doesn't actually help them solve the problem. So what I do with athletes now and what I do with traders I coach as well is that we want to figure out why the problem is occurring. We want to figure out what is causing the problem. That way we can actually kind of put together some tactics and some solutions to deal with it. So reason 1, loss aversion. As human beings, right, losses affect us much more than gains. In general, anything negative affects us much more than the positive things, right? And this goes back to the good old caveman brain, right? Where back then when we were cave people wearing our loincloths and not very well hygiened, we had one job. Our job was to survive, right? It wasn't like today where we're kind of comfortable and I assume I'm gonna make it home every day. Back then you didn't know. There's all types of woolly mammoths and saber-toothed tigers and creatures that I don't even know out there ready to kill you. So the one job that we had was survival, survival, survival. And because of that, we paid super attention to like all of the threats out there, right? It's funny because I'm like this now. I grew up in Philly, so I'm very paranoid of everything. Where if you catch me walking down the street, I'm always like this, like here, you're too close. Hey, what you got there, right? I'm analyzing the situation because of self-preservation. Again, a lot of people don't make it out of Philadelphia, PA. I did, and I'd like to keep it that way. So I'm always assessing these threats. And because our brains are focused on these threats, we value the negatives more than the positives, right? And I may be wrong on this, I always forget the exact ratio, but I believe it takes like at least like 3 positives to make up for every 1 negative. So meaning if something negative happens, you need 3 positives just to even things out and kind of be back at neutral. That's crazy, right? Anyway, what this means is that when we lose in trading, that is seen, or I guess valued more by us, negatively valued, I don't know how to say it, but valued more by us than one win. This is the thing that bothered me back in the day when trading was a lot more scammy on the internet, right? I've always told you guys I'm a 50% trader. In reality, I'm like 55%, but I always say like a 50% trader. And whenever I would say that publicly, I would get laughed at and everyone would come, you can't be profitable trading 50%, blah, 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 blah. And it's because we have this idea as human beings that in order to be successful, we have to win 8 times for every 2 losses. And we see like winning 5 times for every 5 losses to be a negative. Truth of the matter is, right, Most professional traders are under 60%. There are many, many, many great traders. Peter Brandt, one of my favorites, just to name drop one. I think he's historically like 40%, and he's very successful. We don't have to create that 3-to-1 ratio in our trading, I guess you can say. I don't know what the point of that was, but anyway, information for you. The point is, when traders move their stop loss back, or when traders add to their positions, they're not doing so to necessarily make money. Rather, they are doing so to avoid pain. They see that stop loss being hit as something that is painful. It is that negative. It is that threat. So the longer they can avoid being eaten by that bearish candle coming down to get your stop loss, the more they see it as survival. But ironically, by again adding to your position or moving your stop loss back, you are, I guess, surviving for the short term, but you're experiencing a much worse death in the long term. Number 2 is the fear of regret. This is where all of the what ifs show up in your head, right? What if it turns around? What if it just needed more room? All that fun stuff, right? We do this because we don't want to regret making a bad decision, right? Getting out of a trade that might reverse and go higher. But again, the interesting thing about this is that in our attempt to avoid a bad decision, we are actually making a bad decision, or one would say an even worse decision. So it doesn't really make sense, right? A stop loss isn't arbitrary. Ooh, it's my big word of the day. Had it up my sleeve the whole time, just waiting to use it, and I finally got the chance. Thank you, word of the day calendar. A stop loss isn't arbitrary, it is purposeful, right? Our stop loss is placed at a level that tells us from a technical perspective that I am wrong, right? I'm not just throwing a stop loss here, I'm not just throwing a stop loss there. That's why I'm firmly against people that just place random stop losses. So if someone that's like, hey, I just do a 2-to-1 risk reward, or I measure out my reward first and I just put my stop loss half the distance away from that. And I'm like, that doesn't make any sense. Like, there's no protection. Like, your stop loss is random and therefore you'll get random results. I truly believe that your stop loss has to be in the place where your analysis tells you that you're wrong, because when you're wrong, 1, you know you're wrong, and 2, you can get out of the trade. I guess 3, from a mental and psychological perspective, it kind of gives you peace of mind that, hey, the trading idea that I had, right? This was supposed to happen before that happened. Obviously, it didn't happen. You are justified in your loss, meaning that you have acceptance of like, hey, I am wrong. My prediction was wrong. It did not do what I thought it was going to do. Therefore, I should be out. The next one is going to be commitment bias, aka falling in love with a trade. Don't fall in love. Bad idea. Now, some of you may not believe this, but I promise it is true. But some traders can have some pretty big egos. And I'm not just talking about your internet gurus that are out there bragging about how good they are, sharing screenshots from their phone about whatever they did. I'm talking about real traders too. A question that I often get asked is, Akil, what is your favorite trading strategy? And although my initial response is whichever one is making me the most money at the time, which is true, I always go back and I say it is my favorite trading strategy or trading style is discretionary price action trading. And the reason for that is because it makes me feel involved. So I used to trade a systematic system. So I literally came into the charts and I would simply just sit down and wait for an arrow to turn green or red. So my trading day consisted of me doing this. For you guys that are just listening to the audio version, I'm like yawning and twiddling my thumbs and doing your cliche bored person stuff. But I didn't do anything. I just waited for the arrow to turn a color, and if it did, I would do the thing. If it didn't, I would not do the thing. And although it was a profitable strategy, now I ruined it by all types of psychological things that I did back then. I was a bad trader, bad Akil, right? Although it was profitable, I never really got any fulfillment out of that strategy. However, when I switched to a discretionary price action trading style where I'm actually on the charts, I'm doing analysis, I'm measuring this, I'm measuring that, I did feel fulfilled. It's going to sound weird, and again, the main objective of trading is just to make profit by any means, but for me personally, when I was following the system, I would get bored, and boredom would cause all types of weird mistakes and lack of attention, right? When I was doing this discretionary style, I felt like I was in it. I was doing the work. I was more focused and locked in than ever before because I had to, because I was actually doing analysis. I was, severance, picking out little numbers that pop out of other numbered things. I still have no idea what they're doing, but I just saw a goat room in the last episode I watched. I'm not going to spoil it for you, but it made me feel involved. It also gave me a sense of achievement when a trade would win. So with the red arrow, green arrow, a trade would win, I'd be like, all right, I didn't do anything. Like, the system told me everything. But when I would analyze the market and the prediction would come true, man, it felt good. It felt like I did something. And that kind of, that dopamine hit is what would motivate me to not only do the same type of analysis at the same level for the next trade, but also continue to learn and evolve as a trader, like want to get better. So I bring that up because in a sense, I was getting emotionally involved in the trade, meaning that I was prideful, I was happy, I felt like I was doing something. And oftentimes there's a downside of that where when we feel that way, it's hard for us to go the other way. Like, imagine you invest all this time, energy, and effort into doing analysis. And the secret is 90% of your analysis that you do is not going to come to fruition. Like, nothing's going to happen of it. You're going to right click, erase drawing tools, and start over. But imagine investing all of that and the pride you get when you're like, oh my gosh, I actually identified a trading opportunity. And then the market does the opposite. Well, what we should do is we should right click, erase drawing tools, start over. But what often happens is we stay married to that trade because we're so emotionally invested in that original short idea. Even when the market is screaming buy, right? Sorry, I couldn't keep a straight face doing that. We still want to sell because we can't get off of that idea. Very similar to like when I attempt to build something around the house, and the keyword attempt, and it looks like crap. And I know it's crap. And my wife knows it's crap. And she's like, hey, we should call someone professional to get this done. And I'm like, why, babe? It's already done. And it's, I just can't, like, you because you emotionally invested in like making something. It's your own creation. You want to stick with it, even if it's unsafe for everyone involved. So as traders, right, we can't have this commitment. We need to be we need to be mercenaries in the market where it's like, hey, we're fighting for one side, but as soon as that other side offers more money, we are switching over, right? We don't have to have loyalty to the buy side or the sell side. We just have to have loyalty to whatever our analysis is. And as the market conditions change and as they provide us with new information, we have to be willing to change as well. If you continue to cling to a sinking ship, guess what's going to happen? You're going to sink right along with it. Oh, my knees. I don't know if you guys heard that. That hurt. Anyway, here are some solutions, right? What do we do? Well, spoiler alert, these answers aren't going to be anything different than what I've always preached for the last decade and a half here, but I'm going to give it to you again because people are new, or you just need to be reminded over and over again. But 1, have a rules-based trading plan and actually follow it. If you have a rules-based plan, it really simplifies the process. Your job is simple. Follow the rules. Even if you're doing discretionary price action trading, it's very similar to that mechanical system I told you about, where it's like, hey, this is what you're supposed to do. Do it. Do nothing else. If your stop loss is supposed to be here, honor thy stop loss. Don't move it, right? Sweet and simple. Many traders get into these issues because they don't have plans, so they don't have anything stopping them from making those mistakes. People still make mistakes when they have plans, but it's a lot easier if I have like complete freedom because I can justify it versus if I have a trading plan and I have to fully admit that I'm breaking my rules. Especially if you have an accountability partner that's going to call you out on it later. Number 2, use proper risk management, right? I know there's some nonsense out there on the internet that says, don't use a stop loss because the other side of the market knows where your stop loss is at and they are going to trigger it. They don't care about you. Trust me. Brokers do not care about your measly stop loss. They know where stop losses are at in general because humans are very predictable. And even I know where your stop loss is going to be, right? So it has nothing to do with your actual stop loss. They're not hunting you or anything like that. That is false. So please use a stop loss. It is your safety net. Do not jump out of a plane with no parachute. You will go splat. And not just a stop loss, when it comes to risk management, just make sure your position sizing is on track as well. Something I didn't talk about earlier when we talked about the sunk cost fallacy and adding to your position as it's going against you. This is why I'm so highly against that thing called the Martingale technique. Now, there is a podcast episode on it. I remembered it before I started recording. I think it's 1040, so 1040. I think it's called like 4 position sizing strategies, and we go into more detail about the Martingale strategy there. But essentially, the Martingale strategy is a strategy where as you lose, you double your position size so that you can make up for those losses. Now, you can use your brain and you can think about the downside of that and how poorly it can go as you continue to boost your risk while on a losing streak. But the point is, we want to have a position sizing strategy that protects us and allows us to absorb the bad so that we can get to the good, versus no position sizing strategy where we can do whatever the hell we want, or a position sizing strategy where we actually put ourselves in more harm. Number 3, think bigger. One trade should not make or break your trading year, right? I shared with you guys with the last week or so, I have my biggest trade of the year on the dollar yen, right? A big like 250 pipper, blah, 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 like that, right? If I took that away from my trading log, right, and still looked at my end of year return on investment, it would still be good. My profitability or non-profitability wasn't based on that single trade. So although I'm very happy with it, it made me money, especially around Christmas where I'm trying to buy the kids as much stuff as possible. It doesn't really make that much of a difference. And I say that because we don't need to value any individual trade more than any other trade. And when we start assigning these values of it, or this idea like this has to be the big one, or I can't lose on this one, we're just putting ourselves in a pressure-filled situation for no reason. The truth of the matter is, this trade doesn't have to win. This trade can lose. It doesn't really make a difference, to be honest with you. And if you want proof of that, right, go through all your results and just pick a random trade and take it out, and then look at what your final ROI looks like. You probably won't notice a difference. So stop giving it that energy. It doesn't deserve it. Lastly, number 4, journaling. Everyone's favorite thing to do, right? You should journal, right? In general, you should journal, but you should journal while you're in a trade, and journal specifically your emotions, right? As that big red candle is plowing through your protective levels of structure, inching closer and closer to your stop loss, how do you feel? Do you feel anxious? Do you feel nervous? Do you feel fearful, right? Write this stuff down. Yes, we know that we make psychological mistakes as traders, and it's all good to be like, yeah, Akil, I make psychological mistakes, but that does nothing to help solve the problem. Like I mentioned earlier, if we want to start putting together solutions for our problems, it starts with understanding what is causing those problems. Speaking of problems, we may have a power problem. I don't know if you guys saw the lights and stuff blinking. There's a storm outside, and I think the power is going to go out. So I'm going to wrap up this podcast so I don't lose it. Thank you guys for joining. Follow if you don't follow already. Check out the YouTube channel. Lots and lots of content over there to help you become a consistently profitable trader. Have a Merry Christmas if I don't see you before then. And yeah, until next time, plan your trade, trade your plan. Take care.